Good evening and a very warm welcome to all the participants and the investors in the monthly webinar of Ambit Asset Management. We have with us today the fund management team, Mr. Bhargav Buddhadev, who manages Ambit Micro Marvels portfolio and co-manages Emerging Giant Small Cap portfolio. And we also have with us Mr. Trilok Agarwal, who manages Ambit Good and Clean Mid Cap portfolio and Ambit 10X portfolio. Over to you, Trilok and Bhargav. We can start with the session.
Yeah, good afternoon, everyone, and thank you for attending our webinar. We'll first start with the portfolio performance, starting with Coffee Can. Yeah, so for the month, if you look at the Coffee Can portfolio, obviously, the returns were flattish versus sort of good returns from Nifty. So to that extent, there was a negative alpha, but obviously, the last 1 year performance has been fairly credible. In terms of the top performers, were the Bharti Airtel, TCS, Kotak Bank. Amongst the draggers were Avenue, ZF, and HDFC Life. Moving on to Good and Clean. In terms of the Good and Clean performance, it was a fairly strong performance in Good and Clean. In terms of the top performers were the Federal Bank, AU Small Finance Bank, and 197, which is Paytm. In terms of the draggers, were the Supreme Industries, Deepak Nitrite, and Aegis Logistic. Moving on to Micro Marvels. So if you look at the Micro Marvels portfolio for the last 1 month, the returns were 0.3. The last 2 months has been sort of flattish for Micro Marvels. In terms of the top performers, was Rajratan Global Wires, Global Spirit, and Mayur. In terms of the bottom performers were Didev, Menon Bearings, and Food and Inns. Let's move. Also, we have the AIF performance, which is Ambit Pricing Prowess. The returns for the month were 1%, and in terms of the top performers were MCX, Bharti Airtel, and Phoenix Mills. In terms of the draggers were Avenue Supermarket, ZF, and HDFC Life. Let's move to the topic of the webinar. So this time around, we've chosen a very apt topic, given that in Mumbai, sitting in November, we experienced rainfall, which we have arguably never experienced. So we thought it's apt to look at climate change as a very interesting topic. Obviously, in the financial market, this is very much ignored. But what our study suggests is that there are widespread financial implications as far as climate change is concerned. So let's deep dive into this newsletter. Starting with the global temperatures going up. So if you look at this chart, it's a very interesting chart because it captures the global average temperature for the last almost 100 odd years, more than 100 odd years. In fact, if you look at the increase in temperature over this period since 1850, in fact, the average temperatures have increased by almost 1.5 degrees. And this is a very stark sort of increase. And the estimate is that possibly over the next century, this can further increase by around 2 to 3 degrees. Now, why we are saying that the increase in temperature leads to a lot of serious consequences? Obviously, we take you through each of the consequences in the subsequent slides. So let's move on. Yeah, we can move on to the next slide. Yeah, so if you look at what happens when suddenly there is global warming. So if you look at this particular chart, it shows you the kind of losses that countries go through whenever there is a global climate change. So if you look at various years from 2015 to 2024, the losses that have been faced on account of global climate change have been in the range of $100 billion to as high as $400 billion. But the most interesting part about this is that still countries haven't realized that they should have taken insurance for the loss caused due to climate change. So if you look at the dark shades in the charts, you can see that the share of insurance for losses from global climate change is not even 10%. In fact, it's only in 2024 that the insurance protection has crossed 12 to 13% of the overall losses that have been caused by global climate change. So, what we are effectively trying to highlight is that clearly what is happening is that more and more realization is being crept into the fact that one should take insurance to ensure that the losses from global climate change are covered, and this effectively is becoming a very, very big industry. Moving on to the next slide. If you look at the disaster frequency since 2000, it has virtually tripled over 2000 to 2024. And if you look at countries which have gone through a lot of disasters, is primarily US. So you can see the dark shade into each of the tall buildings which you see on this chart, that the share of US in the disaster frequency has been consistently rising. So even a developed country like US is going through a lot of disasters caused by global climate change. Moving on. This is a very interesting sort of a table which our team has sort of created. What this table shows you is that what is the impact on the EBITDA margin across companies on account of climate change. What we believe is that the range of impact on EBITDA margins is anywhere between 5 to 25% across various sectors. So you can see various sectors highlighted in the slides, ranging from utilities to construction and infrastructure to materials to food and beverage to oil and gas, etc., etc. So what we are trying to highlight is that the losses caused on account of climate change are getting into very serious zones, and impact on the EBITDA of 5 to 25% is very, very serious. And in fact, what we are trying to highlight is that if the temperature crosses or increases by another 3 degrees, maybe in the next decade, then obviously you get more into the 25% kind of a territory as far as EBITDA losses is concerned. So let's move on to the next slide. Yeah. So obviously, as of now, what we understand is that right now only disasters are visible as far as losses on account of climate change is concerned. Nobody is actually looking at the impact in terms of the financial impact which is being caused. For instance, if you look at the banking sector, there are a lot of loan defaults which are happening on account of losses caused due to climate change. So, for instance, if there is a loan which has been given to the agri sector, if you look at India for that matter, this time around we had excess monsoon and there is a lot of crop losses on account of excess monsoon. Obviously, most of the loans which have been given to the agri may not have been insured. So obviously, this time around, we are seeing a few banks which are reporting losses on the agri portfolio. For that matter, even agrochemical companies, when we look at the results, we've seen very disappointing results from agrochemical companies in India. Also, globally, the sector has been under a lot of stress. So, clearly, what we are trying to highlight is nobody as of now is talking about the financial implications of the climate change, but it is very important to keep a note of this. And we believe that going forward, there are many industries which one can also look from an investment perspective as far as plays on climate change is concerned. Moving on. Yeah. So, in terms of various sectors which one can look at in terms of a play on account of climate change are obviously these, starting with agriculture. So, obviously, what happens is that whenever there is a climate change related increase in weather patterns, obviously there is a significant impact on the yields. So this is the first thing which is very much visible, and in fact in India also this time around there have been a lot of loss in yields on account of varying weather patterns. The impact of this is obviously on inflation, given that the agricultural output gets impacted, and the resultant impact is that there is widespread inflation. Obviously, if you want to minimize the impact going forward, one can look at investment opportunities in drone companies, which obviously will be used more and more to for monitoring purpose, as well as a lot of climate smart tech equipment companies, which can be sort of looked at from an investment perspective. The second thing is in manufacturing. So obviously in manufacturing, what has happened is that there have been widespread floods this time around, especially in the western side, northwest side of the country, and we've seen a lot of factory shutdowns on account of these floods. So obviously, the weather changes results into such kind of activities as well. In terms of impact, what we can see is that obviously the manufacturing cost increases a lot. There is a widespread fall in the productivity as well. For instance, if the weather patterns during summer are getting into extreme zone, then the labor productivity also gets impacted. So to that extent, there is a productivity impact as well. So how can we minimize that? Obviously, one way to minimize that is to look at investments more into renewables, because if you want to sort of reduce the carbon footprint, it's very important to shift to renewables. So the future for the renewable power as a theme can be fairly bright if one has to take a call on investments to mitigate climate change risk. Likewise, other sectors like utilities, real estate, retail, transport, and logistics also benefit as a play as far as climate change is concerned. Obviously, we have more details in the newsletter, which we have emailed to you. So, would advise you to go through the newsletter. It's a very differentiated piece and very futuristic, and there are several examples also been given in terms of live examples to further corroborate the impacts on account of climate change. I'll now pass it on to Trilok, who will cover the macro piece.
Thank you, Bhargav, for taking us through a very insightful topic. So what we are seeing is A obviously post a very strong Diwali and subsequent festive season, thanks to the GST cut and subsequent demand pull from a lot of sectors. We obviously would like to draw attention on what are we thinking and what are we seeing in the rural market. So A obviously rural market continues to build from strength to strength, and we have seen this is now the third consecutive quarters where real agri wages have seen an uptick. Moreover, non-agri wages also, thanks to a strong up move in the construction and the real estate piece of the part of the country, have seen a very strong growth. So now we are, it's like a nearly a 40 quarter high that we have seen, aided by both low inflation and good agri output. So we think, apart from the GST benefit that we are seeing, that has been enjoyed by the no, by the citizen of the country, we have also seen the rural part of the country, which is steadily, slowly improving every quarter on quarter. Moving ahead from rural to the what's happening on the ground. Can you move to next, please? As I said, thanks to the GST impetus, two-wheeler sales have done very well, and this is only September data. So please bear in mind, October was even stronger. October we saw double-digit growth across two-wheeler industry after many many sort of duration of low single or high single-digit growth. Similarly, farm and tractor income has done very well. So tractor is obviously now 18 quarter high. So we think it corroborates well with the rural recovery that we are seeing across a lot of segmentation. Moving ahead to next, even the rural spending, coupled with income, real wages going up, low inflation, consumption picking up. So we have also seen rural, spending clearly outpacing demand from the urban point of view. And this is, seen across sectors: auto, jewelry, consumption, paints, textile. We have seen some broad level of feedback around that, except for the fact in textile, we have seen some challenges because of tariff imposed, particularly by the US. And, obviously, we all are waiting for the final tariff deal that will happen between India and US. Moving ahead, what are we seeing in earnings so far? So as on 30, this is obviously as on last week, we have seen, nearly 50% of the companies delivering in line with the sort of results, earning expectations, and nearly one fourth of those have delivered above expectations. Broadly, earnings continues to be in the sort of moderate range. Earnings of Nifty between 5 to 9%. That's been the quarter for now, 7, 8 quarters in a row. Importantly, this quarter, a lot of commodities and refinery companies delivered exponential YOY growth, which is why this company looks to be even these numbers looks to be quite decent. X of financials and X of commodities numbers would have obviously been a little more muted. So not only are we seeing moderate earning growth, but when we move to next slide and we showcase about the earnings downgrade, we have seen a broad level of earnings downgrade across the segmentation. Moving next, please. So if you look at the construct of the earnings, as I said, it's led by primarily commodities, oil and gas, and also some bit of construction materials. Now, if we exclude these commodities broadly as a segmentation, earnings would have only delivered a 3% growth YOY, and that's been the usual trend for this year. FY26 first half, excluding commodities, Nifty would have delivered 3 to 4% earning growth versus a reported number of 7 to 8%. Moving ahead, not only the construct of the earnings are quite skewed towards commodities, but even the earning downgrade continues if you look at across the segmentation. So when you look at the top 100 companies, we have seen so far a 75 to 100 basis point cut so far in 26, and similar sort of number in 27. The mid cap and the small cap companies continue to see even sharper cuts. For that matter, small cap have seen a 4% cut in earnings so far, and that kind of number is 2% for the next fiscal. So clearly, visible earning cuts are very pronounced, particularly in the smaller bucket of companies. But we think as we proceed to next quarter and next fiscal year, once the clarity emerges in context of what are the tariffs they're going to pay, and also the consumption picks up, primarily led by income tax cut as well as indirect tax cut in GST, we think the growth will rebound sharply in FY27 in the mid and small cap space, because that's usually been sort of a pattern that we have seen in mid and small caps. You will all obviously see surprises on the upside on earnings as well, and market tends to be more measured in terms of what growth expectations is built in this particular category in particular. Moving ahead, valuations. So valuations, obviously, we continue to look at Nifty. If you look at in totality, so Nifty continues to be in the long-term averages. But more importantly, our premium over in the emerging markets have actually now come down to long-term averages again, and we are only marginally higher compared to long-term. In fact, on the same time during the same time last year, we were at nearly 80% premium to long-term averages for the versus emerging markets. So I think this is again a very sort of critical juncture in the markets where economy is poised to recover in the H2, led by rural recovery, GST consumption pattern, as well as clarity on export emerges. I think we also would like to believe that once economy numbers start to reflect, markets will be sort of very very buoyant and constructive on that note. With that note, I would like to commend my sort of commentary on macro, and I would like to hand over to the moderator for question and answer session. Thank you very much.